India's composite PMI and services PMI, that is the Purchasing Managers Index for April, came in at 13-year highs, highest since 2010. Now, another data point, auto companies reported record sales for FY23 after a long drought. The fourth quarter results, that season that's currently underway, has now seen more hits and hardly any misses. And finally, yields on government securities and corporate bonds have fallen in the past 1 month, 2 months by 25 to 50 basis points. That's equivalent to 2 rate cuts. All these point to a fall in the cost of capital for companies. So the question we are asking today is, will economists have to upgrade India's growth forecasts for this year? That's FY24. RBI stands at 6.5%. Most of the market economists we know stand between 5.5% to 6% GDP growth forecast. Nomura is at 5.3%. ICICI, I think, is at 6%. Will these have to be upped? I'm joined by Sonal Varma, the Managing Director and Chief Economist, India and Asia ex-Japan at Nomura, and Abhishek Upadhyay, the Senior Economist at ICICI. Abhishek, Sonal, thank you very much for joining me. Well, before I come to the big growth question for which this debate has been called, Abhishek, I wanted to get your view on the fall in yields itself. Is this sustainable? We were at, 7.45 immediately after the budget. And I think the average of the previous 6 months also would be between 7.3 and 7.4. This substantial fall to 7% will hold?
For the decline that we have seen in the bond yields. You're right. I mean, earlier range, if you compare since November, 10-year bond yields were mainly trading around 7.3, 7.4 levels. I think the range broadly has shifted from 7.25 to say 7.25. A couple of reasons, both domestic and global. On the domestic side, when yields went higher in February to beyond 7.4% levels and closer to 7.5 levels, what we had that time was worry that RBI would err on the side of over-tightening. That was the impression many people got after the Feb monetary policy meeting. And then you had that Jan inflation data, which was released in Feb after the RBI meeting, which surely turned heads and really surprised higher. Subsequently, what we've seen is inflation coming down and inflation internals have improved considerably. Also, on the global side, there was worry early March that Fed will take rates to perhaps closer to 6%. Now there is,
Abhishek,
a lot of conviction.
Abhishek, more than the reasons why it fell, I would want to know whether are Indian corporates in for lower cost of capital? I mean, if 7 is the benchmark, then even corporates, already corporate bonds the spreads have been falling. So can we believe that there is lower cost of capital in FY24?
I think so. If bond yields decline, corporate bond yields will also be lower, and you are seeing that. So, borrowers from bond markets, mainly private sector NBFCs and certain PSU issuers, should benefit immediately. But if you're talking about the banking system, I still think the transmission of monetary policy, the rate hikes done over last year is still taking place there. If you look at the weighted average term deposit rates, it's still the increase there is still less than 100 basis points. The weighted average lending rate has only increased about 95 basis points since the rate hike cycle started. And with liquidity conditions tightening, I think there is more scope for there to go. So, it is possible some lending will shift from banks to corporate bond markets, but India is still a banking sector-led economy. And I think the transmission of past rate hikes will be the overwhelming influence still.
Oh, okay. So cost of capital increases, you say, for the large number of people. Sonal Varma, now to the bigger question. Are you sufficiently influenced by the rise in the PMI, the domestic growth cycle, to revise your data, your forecasts upwards?
Not yet, Lata. I think, in terms of the coincident indicators, I would say they've generally been more resilient, I guess, but at the same time patchy. So take it one by one. Let's take the strength in PMI. If you do a historical correlation between the manufacturing and services PMI with the manufacturing and services GVA numbers, what we find is that the correlation is actually negative between the GVA and PMI number. And there's a very small positive correlation between services PMI and the services GVA. So the services PMI to an extent does indicate that the services side is generally resilient. But the extent of the correlation between the PMIs and the GDP numbers in India generally has been historically low. So one has to keep that in mind. Similarly, for instance, the strength in credit numbers, real credit growth has historically been a lagging indicator of the business cycle. So I think, the FY24 financial year has just begun. Our view is a US recession is likely in India's FY24, and therefore the spillovers to the goods cycle and to the services export cycle, and also I would say more broadly to the investment activity is still ahead. And, let's not forget that it's been just 1 year since the RBI embarked on the tightening cycle. So we haven't even seen the impact of the tightening. So I think it's a bit too early to be saying that it's all clear.
Okay. But no, I take your point that the US recession is going to start telling. And we already see the April figures for exports at 33 billion was it? Was anyway 18% below the year ago exports. But year ago was Ukraine war and prices were very high. So that was anyway an unsustainable number. But if you looked at services exports, although April and March exports are lower than February, it is still higher than year ago exports. Services exports are still holding up. And there is an argument that we may have a competitive advantage. And the, GCCs, the global captive centers may actually move because of the wage inflation in the US. That argument is at least proven true for the last 1 year. The services exports are only growing higher. So therefore, do you think that we may be less impacted and there could be reasons to come close? RBI is at 6.5, you are at 5.3. So is there a chance that you may have to upgrade?
Well, anything is possible, Lata, but I think we need to see more evidence on how things play out. So, for instance, on the software side, the GCC side may be a structural story, but you also have, for instance, some of the IT companies guiding you that it's going to be a low single-digit increase. So the software services, which is still a chunky part of our services exports, has less amplitude in terms of the cycles. It's not immune to a slowdown in demand in US, Europe, particularly from the banking and finance vertical. And, previously, for instance, you mentioned FY23 auto sales are a record high. You look at the April numbers, while the wholesale numbers are strong, retail auto sales are actually on the softer side. So dealers are seeing a buildup in inventory. You're seeing discounts being offered. So I think there are signals that the consumer discretionary side is also softening. Now, the drop in oil prices, the moderation in inflation, the easing we are seeing on the interest rate front in the markets, at least, is positive, but it's a positive that will have a medium-term positive impact. I think it means India can bounce back stronger. But the impact of the last 12 months, I think, is still in traction, and therefore one cannot jump the gun.
Okay. No, I take your point about auto sales. The April sales were, I think, 1% lower for two-wheelers and 7% lower for passenger cars, but three-wheelers were some 50% higher. But bank credit, air traffic, rail traffic, these are the ones where a substantial amount of green is seen even in April. Abhishek, what's your composite take? You look at PMI, you look at bank credit, you look at number of passengers in rail and air. Are you getting a sense that there is an uptick?
High frequency data is, surely resilient, you can say, except for core imports that we saw, clear sharp decline there since September onwards. And that was the main driver why trade deficit came down, not oil trade deficit, but non-oil trade deficit was a key driver. But in March, there has been an uptick. I think if you're looking for silver linings, I think silver linings mainly on the rural demand side, and which is important because in the past periods of global growth stress, it is the rural economy which has helped buffer the shock for us. Still quite weak, but if you're looking at indicators such as rural wages, even two-wheeler sales, have recovered. There are some silver linings there, but again there are headwinds. I agree that I mentioned before, transmission of rate hikes is still happening. On the rural demand side also there is risk from monsoons this year. So we have to consider those factors, and I still broadly think that risk to our 6% growth forecast for this fiscal surely leans towards a lower number rather than a higher number.
Oh, a downside risk to your 6% is what you think? Okay.
Yes, we are
just that
6% a bit downside.
Okay, 1 minute. Then let me just get a monosyllabic answer from both of you. Sonal Varma, upside risk or downside risk to 5.3?
Balance, Lata.
Oh, please. Abhishek, upside risk or downside risk to 6%?
Downside.
Oh, okay.
Downside risk.
Then, all right, then the two of you have put my thesis, have made my thesis stand on its head, actually. I was expecting an upside risk, at least, to your forecast. I will wait for more silver linings. Thank you very much, Sonal Varma and Abhishek Upadhyay. So, for all the silver linings we have in terms of lower cost of capital, as well as positive PMI, economists believe that both the fact that interest rate hikes have to be passed down, as well as because there will be a global dulling of demand because of the coming US recession, there is no scope for them raising India's GDP growth forecast. Wrap up on Bazaar, Chatbusters up next.